What's going on, everybody? I apologize, running just a few minutes late here. Had a little bit of a technical difficulty for some reason. StreamYard here like shrunk my display there, and it was going to look really weird. So anyway, worked on it, fixed it, got it all done for y'all there, and I'm here. How are y'all doing? Y'all are just a mess here. Reading the comments. Oh man. So what a week, what a day. I guess Trump tweeted something and the market got a knee-jerk reaction. Generally, especially when it comes to Bitcoin, where we were looking for it to go. So no real surprise on the fact that it did it. We'll talk about that here in a bit, but I wanted to start this by talking about, so there's this idea of, are things different, right? Because the most dangerous phrase in trading, in investing, in markets is this time it's different, right? Because it's not, right? But we look at the structure, and I kind of want to talk about real quick here about what is different right now, but what's never different. And there's, it's what you have to think about, okay? But with that in mind, the question I've posed today on Twitter there and across social media and whatnot, and even within the headline of the show is liquidity confidence the new bubble? So let's talk about what that means. So how are things structurally or, different these days than it was prior to COVID, right? COVID was this point at which things change for what the Fed can do, what the government does, all that kind of stuff. And so the toolkit now is a lot larger. The Fed's toolkit now is a lot larger than it was pre-COVID. And this is all in response to what happened back in, 2008, the great financial crisis, and then, coming up to it here. So since 2020 now, the Fed can deploy instruments that didn't actually exist back in 2008. So we've got things like unlimited QE with flexible maturity targeting. We've got standing repo facilities, SRFs, and FEMA repo there to backstop that global dollar liquidity. We've got corporate credit and ETF purchase mechanisms, and those were tested in 2020. You might have remembered, the Fed going out there and, buying some things, and people going, well, you know what? I don't know that that's really constitutional. They can go out there and buy these private companies and whatnot. They've got forward guidance and instant communication channels now. And those are going to, those kind of help stabilize expectations faster. So those things then make liquidity crisis less likely to spiral. All right. Because the Fed can, inject reserves or absorb collateral stress, within hours instead of weeks. And so that's kind of where we're at here. Also, COVID actually blurred that line between central bank and the Treasury. So fiscal spending was monetized at scale, right? And then markets learned that policymakers will act together to prevent collapse. So that playbook now lives in the current trader's muscle memory, I guess you could say. It changed basically our reaction function. It changed our reaction function. I guess the best way to say it. Basically, when stress hits now, the assumption is really liquidity is going to arrive, right? I mean, isn't that what we all think here? When something happens, we think, oh, the government's going to inject liquidity, right? I mean, that's what everybody talks about. Liquidity, global liquidity flows, all this stuff, right? It's really where we're focused now. And this is something we hadn't really been focused on prior to recently. And so the other thing beyond that is that digital plumbing, right? Market infrastructure, things like collateral mobility, things like repo automation, things like payment rails. Those are all much more robust today than back, say, in 2008. So that, that kind of 2008 style interbank freeze is a lot harder to imagine. But even with all those things that are different, what isn't different? What will never be different? And this is the part that a lot of new traders have trouble understanding. Okay. Excuse me. Sorry, I've got something in my throat here. So what's different? What's never going to be or what's not different, what's never going to not be different, right? Liquidity doesn't equal solvency. So the Fed can, fix a run on funding, but they can't fix a hole in the balance sheets. Structural losses, credit deterioration, valuation bubbles, those things still unwind the hard way. Psychology still drives contagion. And I spend so much time talking about psychology here, right? So even with all that better plumbing that that I was just talking about a second ago, humans still panic. So that reflexivity, that feedback loop, they remain the core fuel of a crisis. So tools calm the system, but only until the belief in those tools, erodes, ceases to be, right? Again, we're going back to the human point of markets. And I think another really big thing is this policy dependence creates fragility in the system. Because again, as I was saying, the market now assumes rescue all the time. That's not stability. It's conditional stability, right? Every basis point, I posted this a little bit ago, every basis point of volatility suppression today adds to convexivity risk tomorrow, right? So when the next shock actually comes and the Fed hesitates, whether it's for political or inflation reasons, whatever it is, that air pocket there could actually be a lot worse. Okay. So mechanically, this time is different. Structurally, mechanically, it is different, right? The Fed can act faster. The Fed can act bigger. It can act in more targeted ways than it ever was able to before. Yeah, as Bernardo says, the wonders of central banking, exactly. But dynamically, it's still the same. You still have moral hazard. You still have herd psychology. You still have leverage. All those things are going to reassert themselves once traders believe the system, is quote unquote safe, right? Because then you don't have that so much of that worry of these things happening. So what does that mean? Well, it means this new regime then might delay risks, right? It might delay crashes. I shouldn't say risks, delay crashes. But it also inadvertently builds the conditions for sharper, rarer breaks. So kind of, I guess you could think of like liquidity cliffs that are disguised as resilience, right? So how do we kind of look at that? Well, if we look at say 2020, right? That was the shock and the rescue. So volatility exploded. We had the COVID crisis, right? I mean, instant drop, right? And then the Fed intervened massively. The QE infinity, credit facility, swap lines, all that stuff. And so the result was that you had this liquidity flood that everybody's still talking about today, right? And so the markets were rebounded within months. It was just that huge V shape, remember? And so then we moved into 2021, and that gives us the calm after the rescue. And so volatility collapsed to pre-pandemic levels. I even mentioned that on the show here, I believe, at the time. Was talking about how we'd already just collapsed all the way back down in terms of volatility, right? Prior to the pandemic. Confidence surged, risk assets soared. And so traders learned that every shock invites rescue, right? That's kind of where we're getting to this point we're at today. And then 2022 comes in. Hello, inflation, right? We had inflation shock, we had rate panic, we had all those great things. And so inflation then broke that illusion of that unlimited easing. And so the Fed then tightened aggressively, right? We had QT then, which, by the way, is still kind of generally playing out, though a lot less today than it was back then. But still, it came in tight and came in hard, right? Volatility rose again, but the system didn't break. So that showed the power of this new facilities, right? The SRF, the ON, the reverse repo, all that stuff. Keep going forward to 2023, 2024. And at that time, we had, some kind of controlled disorder, I guess you could call it. So we had smaller volatility spikes. Remember the bank stress? They're talking about regional banks and all that kind of stuff, the bank stress stuff, debt ceiling stuff, AI bubble stuff, all that. Remember, these were talking points that the traders in markets would have back then, right? But all of those things were then met by these measured interventions, not panic. So each episode then was shorter. and the Fed could backstop without a full QE type thing. Okay. And so then we get to today, 2025. And I guess we could call this kind of like reflex fatigue. So each calm stretch shortens, right? So each period between these things starts shortening. And then every rescue trains the market participants to expect stability. And then that creates that compressed but really fragile cycles. And I think that's where we are. Okay. So when we talk about this, I think kind of like the core way to look at this is that each Fed save, each time the Fed comes in and saves, right, shaves off tail risk, but it also shortens the memory of fear. And again, remember I talked about what things don't change: human psychology, herd psychology, human psychology. This stuff does not change, right? So over time, then we can probably figure that liquidity confidence is becoming this new bubble, right? This confidence in liquidity continuing to be brought in is going to do it. But again, as I talked about at the beginning there, that doesn't plug balance holes in balance sheets or stuff like that, right? So liquidity is not the end all be all, right? So that's why I'm thinking like the next genuine shock, one that the Fed, it can't easily counter, something like geopolitics, energy, credibility loss, something like that, right? That has a good chance of hitting a lot harder than what the models right now are suggesting. Does that make sense? So it's not just, print liquidity and everything's going to be fine, because liquidity it does not do those other few things, right? It doesn't plug the holes in the balance sheet. It doesn't do those things we talked at the beginning here that people just, I don't know if they're just not thinking about, or maybe they don't understand. But these are things you have to consider. Now, am I saying we're going to go crash tomorrow? No, I'm not saying that. But what I'm saying is this, we get this constantly. People are saying, things are definitely different this time. And other people are like, things are not different. And we have to look at it as the underlying system, the way it runs, the way it does is different. Mechanically, it is different today than it was 2008, than it was really, pre-pandemic. But the thing that isn't changed, the thing that doesn't ever change, the thing that will never, change are human beings, human psychology, herd psychology, all these things that kind of drive us, right? They're the things that make us not believe in those mechanical things. So we believe in them until we don't anymore. Now, that could be next year. That could be 5 years from now, whatever it is. But I think this is something that you kind of need to follow here as we continue, to rally to new all-times. Gold, new all-time high, almost 4,100. Silver, new all-time high, first time in decades, right? Nearly clipping $50 an ounce, right? Now, that's on futures. I think on spot it did actually hit just over 50. S&P, NDX, the Dow, small caps, Russell 2000, all of them hitting new all-time highs, right? Bitcoin hitting new all-time highs, Ethereum hitting new all-time highs, right? Everything's hitting new all-time highs, except, of course, for the DXY. So all markets everywhere hitting all-time highs. So you need to be careful. This is not something that's sustainable consistently for, it's just going to keep on going on and never have to, there's never going to come a time where you don't have to pay the piper, right? Things don't just go up measurably forever. But for right now, we're looking all right. And none of the real kind of 20, 30 indicators that usually indicate a top have really even tripped right now. So I think we're good still for now. I think we're still higher for longer. We hit my 4,000. I was talking about gold likely having to hit 4,000 before we get some kind of really, major pullback. We've hit that. I said the Dow was likely to hit 50,000 before we had any type of real recession or anything. We're not quite there yet. Bitcoin's only at 120, whatever, 125, 128,000 all-time high. So I think we've still got room here to continue going. Let me see here. So what does this mean with what's going on here? So if we're looking at this, what we're actually seeing is tight conditions without panic right now. Okay, so it's this new type of hybrid regime we've got going on. So we've got structural tightness, we've got real rates, and quantitative tightening should historically cause broad risk repricing. Then there's this, but then there's that synthetic calm, right? So the Fed's expanded balance sheet tools, again, SRF, ON, reverse repo, swap lines, stuff like that, absorb that stress in real time. So what that does is it makes market volatility look tame. But it's not organic stability, right? It's intervention. It's policy engineered compression. Okay? And that's where you have to, understand where the risk is. Okay? Because it's not organically stabilizing. It's this intervention with that Fed's, expanded balance sheet tools. So then we get with this structural tightness, that synthetic calm coming together, it gives us this liquidity reflex loop, is what you can call it. And so each episode then, as I continue to say here, trains traders to fade fear faster. Fade fear faster. It's hard to say 3 times quickly. So that leads to that shortening of cycles between the tightening, those cycles, it's tightening, shock, rescue, rally. So that becomes shorter and shorter and shorter, right? So that's kind of the point where we're at here right now. So that means that the system then has evolved from crisis to recovery, which is what it used to be, to this micro crisis, policy pulse, compression. So in other words, what does this mean? Now, I'm talking a lot of big things here, but really, what does it mean? At the end of the day, it means that the market is no longer pricing the Fed, it's front running it. That's the thing, right? I think that's the point we're at now, where the markets themselves are front running the Fed rather than pricing it. And that opens up its own kind of, bit of issues with things. Let me see here. I've got some charts. I don't have them on this computer at the moment here. I'll probably post them on X later today. Or so if you want to see these, I'll post it there. But I've got like this chart, this volatility versus the Fed balance sheet and ONRRP usage. It's kind of like an illustrative chart. But basically what it shows is that volatility troughs tend to arrive after big liquidity pulses and then compress faster each time. So again, what we've been talking about, right? Balance sheets rolls over gradually from its 2022 peak, but RRP, reverse repo, acts like a shock absorber, draining and refilling liquidity so volume doesn't actually run away. And so that combination then basically explains, today's kind of odd mix where we've got tighter real rates and then we've got smaller Fed balance sheet than what we had at the peak there a few years back. But even with that, we've still got calm credit and equity volumes, which is something that would not normally be, right? So I'm gonna put that. I may even just post it in the market breakdown that goes out today. As a matter of fact, by the way, if you're not already receiving that, make sure you guys sign up for it. You can go to themarketbreakdown.com. Fiboswani is going to have a new Friday part in there. He wants to post something every Friday. He's going to call it, of course, Fibonacci Friday, his little corner of the newsletter. And so I've got his stuff from this week already. I'll be putting that in tonight. Looks absolutely great. You guys are going to love it. So it's a free newsletter. It goes out Monday through Friday. Make sure you jump on it there. It gives you a lot of information, about markets and what's going on there. Okay. Let me see here. Bamboo says, Chris, my base case is that when we have the next QE, it will make COVID and GFC QE look like child's play. What's your thought on that? So I think I've kind of answered a bit here with what I've been talking about. The Fed doesn't have to go full on QE right now. Well, right now, that doesn't mean it won't try when we get maybe this kind of big thing that I talked about is potentially leading up to right now. But for right now, it's these little micro things happening, right? and the Fed opens up the spigot just enough through its various tools it has there to, you know, effectively have a type of QE coming in. But it's, you know, it's short term, it's within that small area and whatnot. So I think that's kind of where we're headed. If they do try, though, I mean, I don't see any reason why it wouldn't be like you're saying here. Because that's the way it tends to be, right? Just throw money at it. That's the idea. Is you know, just if something breaks, you know, in the market, just throw money at it. You know, put in more money than what's coming out, I guess, right? You've got a sinking ship. All you have to do is take out more water than is actually coming in, right? You don't have to plug the holes, but that's only going to work for how long, right? That's the question. So I think it's kind of interesting the way things are, right? If I had to look, this is something else I was doing. So I'm looking at past issues we've had in the market, right? And trying to compare these things I'm talking about today with what's going on, say, with like, I don't know, the volatility right now, the dollar, stuff like that, right? And the two things that I come up with are like 2015 and 2008. But I think we're much closer, you know, with you got the, you know, with the dollar strength where it is, contained bond volume, steady credit spreads, but calm overall, you know, this kind of thing. I think we're closer maybe in spirit to like 2015. Because, you know, again, markets are kind of tentatively calm, but they've got vulnerabilities. You know, a strong, as I was mentioning, you know, some kind of strong trigger could produce a violent snapback. But there is still that presence, right, of low volatility. And I think that leaves room for a potential surprise that maybe morphs into something, you know, some kind of deeper stress episode, something more akin to 2007, 2008. So I think, you know, right now, the way it stands, I think we're probably sitting here closer to 2015 in spirit. But there is that low volatility kind of keeps really that door open to something really bigger happening, potentially like 2008. Does that make sense? 2007, 2008. So that's where I kind of think we are. So in other words, I think, again, we still are higher for longer for right now, until we do potentially get that thing that nobody's going to like, that bigger thing that may happen. You know, the things are the way things are right now make it ripe for something like that to happen, but it doesn't guarantee that it's going to happen or that it's even going to happen, you know, immediately or near term. But it does mean you need to pay attention. You can't just be right now blindly, everything's going up, it's never going to end. For those of you that this is your first real market cycle, you've never kind of been through it before, you know, it's easy to get caught up in the euphoria and the excitement and all that stuff. And, oh my God, it's never going to stop. It's never going to stop. And then guess what? Not only does it stop, but it reverses quite violently, right? So, you know, I think we can continue to keep focused on higher for longer, but with these other things in mind of what's going on and just watching how things are continually going on here. And this may be something that I start maybe doing every Friday on these shows, a little bit of this to kind of keep you all in the loop of what I'm seeing in terms of this or any other issues that may be coming up. You know, if you think that'll help you, let me know. I just, you know, again, I do this show not to get up here and show off. I do this show to kind of give you stuff that can help you out. So if you guys think understanding this a bit more and being more aware of what may be going on help you more, let me know. Leave me a comment or something. By the way, hit the thumbs up, hit the like, hit the subscribe, follow me. Follow me. TX West Capital there on X. You can follow the channel here, whether it's on YouTube, Twitch, Facebook, or again, X, wherever you're watching from. But I've got a few ideas about some things to add like that. And maybe as well into the maybe weekly into the newsletter as well. So you look younger. Did I lose weight? Does losing weight make you look younger? No, I'm just here. I'm just here. I've had a lot more stress lately, family stress, things going on right now, family health. But no, I guess thank you, I think. Joseph, what's up, my man? Good to see you checking in, bud. Yes, more, please. Okay, good, good, good. Bamboo says, thanks for the answer. And yes, I'm also looking for some global scenario which might trigger the real QE. Yeah, again, I think that's what it's going to have to be. I don't think it's really anything local to just the US. I think it'll have to be something geopolitical, energy, something like that, that'll really have to set it off. I think as long as we're not getting that, I think we just continue to have the support to press higher, and these micro crisis kind of things that happen. Fed steps in with its tools to kind of produce some QE right there, but without going full crazy train kind of move there, right? Let me go ahead and jump in and we'll look at some charts, guys. Let me see here. Let's pull this up. What do we got going on here? What's up, Bernardo? I see you. Mr. Awesome, I see you as well. Here we got Bitcoin. BB's channel, what's going on, man? This man is a blessing. Been listening since 2022. Scott pointed us your direction. Well, man, glad to have you following along here. I'm not everybody's cup of tea. I'm not your regular influencer out there. I don't, just blindly repost the same news everybody else does. I don't just follow the regurgitated narratives, that most retail traders, post over and over again online. I kind of just work with what's really going on here. And I may not always be correct. I don't expect to always be correct. But, for those of you who've been following me for quite a while, especially in the more macro sense, I've been pretty consistent and pretty true coming up there. Let me see here. So here's Bitcoin again. What do we have? We had our range here, and then we have our range here. And so really, for all intents and purposes, we've really been ranging since, the last week or so, coming into the last week of May till now, right? I mean, this is kind of like our mid-range area. You can see that we have a deviation here, but, really just kind of hugs that. Now, what we've got here, it's been following what I was looking at, what I've been mentioning. It looks like we had a spring down here, show of strength, test of the spring low there, show of strength, last point of support coming back here. We pulled back right here to the monthly R1 pivot. That's this line right here. And it's here on the daily time frame. By the way, it's called the monthly pivots, even though we're on the daily time frame, because they change monthly. Okay. So just as a quick, because I talk about pivots a lot, just for a quick refresher for those of you that may not know or may have forgotten, your weekly and your monthly pivot, the pivots that show up in your weekly and monthly time frames are your yearly pivots. They change every year, just once a year, January 1st. Your daily, 3-day, 5-day, and these daily pivots, daily time frames have the monthly pivots because they change each month, the first of the month. Your hourly time frames, the pivots on your hourly time frames, your 1 hour through your 23 hour, those are your weekly pivots because they change once a week. Okay. Your 15-minute time frame are called daily pivots because they change at the end of every trading day when the new trading day begins. So your 15-minute every day is going to change those pivots on there. Your hourlies are going to change every week. Your daily time frame pivots are going to change every month. Your weekly, monthly pivots are going to change every year. All right. I have got the hiccups here, guys. I'm going nuts. I don't know what the heck's going on here. But anyway, so we've got this pullback. I think right here we're doing a 1, 2, 3, and 4 likely. If we measure this out from the spring to the show of strength and back to the test of that spring, you can see we're hitting that 1618 area. Our initial pullback is always 100%. That's the 38.2 retracement for a fourth wave. Our 78.6 retracement off that 1618 there, or if we just measure all of wave 3, is our 50% retracement. So right now we've pulled back where we would normally expect wave 4 to pull back, 38.2, which just so happens to be on support at that monthly R1 pivot. So let's jump in here real quick to the 4-hour. And so stochastic RSI oversold. RSI never really hitting oversold here, but here we are, right? And so as we look here, we go, okay, well, we have potentially capitulative volume here. We have a downtrend. That last candle in the downtrend has the big volume. It's a bigger volume spike than anywhere else in that downtrend. There's a good chance this may be. If we can get this 4-hour candle to close back above the weekly pivot here at 120,297.88 here on the Bitcoin all-time index, that's going to be a much better indication that the low is probably in here. So the other way I look at this is in terms of patterns, we have basically a descending wedge here. Okay. And so this move, when you have like a descending wedge here and you get this candle that closes below and, well, either wicks below and closes above, or wicks below, or, closes below and then immediately closes back up, it's considered a throw under. And usually that marks the low of that pattern there and heading up. So right now I'm watching to see, can we get some follow through up here to head up? And if we do, which would be a good place to do it, of course, this would give us a pattern target based on the height of the pullback up here of, on this chart, about 131,000. Depending on what chart you're using, it may be closer to 130,000 and some change. But this all-time history index here for Bitcoin has a 131 target. Now, the question is, at there, what happens? Okay, so we could just see a move up there. What we would generally expect is a move up there and then a pullback down here and then your big breakout. I think for most traders, that would drive them absolutely insane because effectively they feel like they've been sideways. Zoom back out here again, as I mentioned, since May, right? And not only that, you felt you were sideways here, and then it dropped, and then you were sideways here, and then it finally rallied, but you were still in the sideways here, or you're just sideways. And then you finally got the breakout higher, and guess what? You're just sideways again. You're not really making any kind of, even in this place, consistent move up. So I think something like that would drive the market absolutely just crazy, retail traders. But that's generally the kind of idea that we would expect there. Let me see here, would be that. Now, there's nothing saying that we can't get some wave 5 overextension that rallies up here. If my 1 and 2 are correct here, wave 3 is a minimum expected target up here at 155. So I think as long as we follow this and we rally from here, I think we've got two ideas. One is we kind of hit that 130, 131 area, pull on back down here, to 120 or something like that. And then we break out higher, which ends up overextending this wave 3 above 155. Or we've been going sideways basically for quite a while now. And when we break out here, instead of stopping there at 131, wave 5 just overextends all the way up toward that 155. So, again, if we can get the rally from here and break on out looking toward that 131, I would just see how impulsive are we at that point. Are we really starting to impulsively break out higher beyond that, in which case we could look up here closer to 155? Or if we're really looking toppish there, we can expect that most likely that pullback down toward that 120 area. Or maybe even, if we did like a flat, this would be absolutely crazy, right? If we get a 5 up here, and then instead of pulling all the way down here, say 118, 120, if price just does a flat correction here, so we get our move up here to finish this wave 1, and then we just do something like this. A, B, C, and then we head up higher, where we just print another range slightly overlapping this descending wedge here. And I think that would absolutely drive traders crazy because it's just more sideways, right? Remember, everybody they call the top here. They call the top here. They call the top, like cycle tops, right? They will, and if you get a rejection, they're going to call the top here. If it comes down, comes back up, they're going to say it again. Comes back down here, breaks out again. I think it would just absolutely throw them to the side. Okay? So that's what I think. Those are the two possible. If you want to know what am I looking at, big picture wise for Bitcoin, that's what I'm looking at. An initial push up to around 130, 131, and around that area, watching to see, do we get some impulsive continued push through that, which suggests maybe an overextension up toward 155? Or do we get our rejection there and potentially pull back 118, 120, or even just do some sideways there and then get the real breakout, what we would call our jump across the creek in terms of Wyckoff, right? I think that's kind of where it's at. But again, if we do get that move to 131 and we get that pullback, that sets up an overextension on wave 3. That means instead of, this larger degree wave 3 up here. So instead of, looking at that 155, if we did that, let's say we got our 131, got our pullback to, here to about, 118 or so. All of a sudden, wave 3, instead of 155, is looking up here toward 176, 175, 176, which then puts your wave 5 closer up here to around 200. Or if that overextends itself, could go higher as well. So again, looking at broad picture, what are my base kind of scenarios I'm looking at here? Notice none of this suggests that we're at a top. I don't believe we are. There's nothing structurally happening here that says we're at a top. As a matter of fact, most of this, especially after this move here, suggests a good likelihood that we're more likely to continue higher overall than to break on down to 80,000 or less, 80,000 or more like that, like a lot of people are talking about. So Bamboo says, if you put the pivots to the Fibonacci setting, so Bamboo's talking about when you're on pivots here. Let me see if I can see this here. There we go. You can change them here. Like I always use traditional. I'm just used to that. But you got Fibonacci, Woody, Classic, DM, Camarilla. I teach all that. I've got a pivots points trading course at members.texaswestcapital.com that you can actually get in with things like 99 bucks, I think, or something like that. But that'll teach you everything you need to know to become really proficient and understand pivots. And I think, especially if you're a new trader, they're one of the easiest ways because you don't have to learn to look left here, which is what I talk about a lot. And it gives you real clear areas of support and resistance. And I show you how, pivots actually work with Elliott wave, with Wyckoff, with, moving averages, stuff like that as well. But Bamboo here is saying that if you change that to Fibonacci from traditional, which is what I have them on, he says Bitcoin is just getting a rejection at the R2, so the monthly R2, and we get above that, and the monthly R3 is around 150,000. So yeah, it makes sense. Again, that wave 3 target with Bitcoin is up there around that 155. Oh, you're talking about the yearly pivot. Okay, he's talking about the yearly pivot. But again, makes sense, right? It gets us up there around that wave 3 major kind of target area that I'm looking at, which is that 155. So definitely something to keep in mind there. Let's see what's going on here real quick with Ethereum. Let's see here. Okay, so we got the pullback. We didn't get the breakout here. All right. So what I'm thinking, this could end up being here, is maybe some sort of flat correction here. So you got 1, 2, 3, 4, 5, A, B, C, or WXY here. We've just pulled back to the range support with that. Let me see again. Let me get rid of this right here. In terms of, let me see if I can get this out of the way. If this is 1, 2, 3, 4, 5 here, we've just got a 61.8 pullback, almost to 70.5. So prime ripe area to get that. You can see stochastic RSI has dipped below neutral here, RSI as well. Let me zoom in a bit. Let me see, 12 hour, what are we looking at there? Yeah, see, that looks like potentially 3 there, though it could be 5 on that. If this is actually 5, though, you get your A, B, and C kind of working down here. That 4 hours reset, unlike Bitcoin, the 4-hour RSI reset here. And of course, stochastic RSI is reset there. Again, looking at potential capitulation volume here. So yeah, I would look and see if we can get a rejection off this area and rally back up. And then things really start looking fun. Then we, if we can get a rejection off here and rally right back up. So we're still printing this, this here. Let's look at the 2 hour. Nope, go look at the hourly. Still printing this. So we're still printing this bullish, or I'm sorry, this bearish fair value gap here. So basically, we got about 10 minutes left. If this candle high stays where it was, what we're looking for then is a 10-hour, 1 hour candle close back above kind of this 4280 area to overcome this bearish fair value gap here that's forming. And if we can do that, that's probably a quick, good indication that the low is likely in. You can see that we are oversold on the 1 hour RSI and stochastic RSI as well. Again, it just looks like capitulative volume down here. That's actually the biggest volume we've had on the 1 hour. It looks like since all the way over here on September 5th on this drop here. So pretty good volume coming on that. Let's see, move up. The other thing you can look at is, again, we have this weekly pivots here. So again, something I like to teach our students when it comes to price action, right? If you have a support area and you wick down below that support area but close back above it, then even though your wick went lower, you understand that the support area held as support, right? If you get a close below that support area, but the next candle immediately closes back up above it, you treat that down candle and up candle as a wick. And so you treat it the same way. So whether you just wick down below the support and close back up above it, or you close below that support and the next candle immediately close back up above that support, in either case, you would take the position that that support held as support there, okay? Why is that important? Because if support holds, right, there's a good chance you're getting a bounce, if not a reversal at that point. And it works the same way from the other side, resistance, right? If you wick out above resistance and close back below it, you say, okay, yeah, that resistance level held as resistance. If you close up, above it and then immediately back down, like you can look here, right? Right here. That's your resistance level. Right here. We closed back above it, so no wick. But the next one, we immediately close back down below it. So we treat this move up and the second candle move down as if it were a wick. And we say that that resistance held as resistance there. And then you should potentially be, you should be leaning toward the idea continues in that direction there. So again, the same idea here. If we can get that same idea, let's close back up. We should look at this as likely to continue up. No guarantees. The only guarantees in trading are you're going to lose money from time to time, and the newer you are, the more money you're going to lose, and the more often you're going to lose it. That's the only guarantee in trading. But again, you're looking for probabilities. If you're fortunate enough to use proper risk management and remain in markets for a long enough period of time, you start understanding what things are more probable to do what. And that's what you're trading as a trader. You're trading probabilities, not possibilities. If you're trading possibilities, you're going to lose, because possibilities mean you're basically looking to enter every time there's a chance. Every time there's a chance. Okay? So what does that mean? Well, so yesterday, I believe it was in yesterday's class. We do classes 3 times a week. And if you can't be there live, we record them so you can watch them afterward. But we talk about the Wyckoff method on Mondays, price action on Wednesdays, and Elliott wave on Thursdays. And I think it was during yesterday's class that I mentioned to you, there's this big thing going around that says, oh, well, if you use a 1R, right? So your target, and you're like this, right? 1R would look like this. Let's say your entry is here, stop loss just below the swing low. 1R would mean that you would be targeting then just right about here. Okay. And what that means is you're risking $1 to make $1. Now, if you just happen to think about it, you go, oh yeah. So if you have a 50% hit rate, if you win half your trades and you lose half your trades, you're at break even on your account, right? Wrong. No. Why? Because if you're trading properly, then your position size fluctuates with your account, with your capital account. The larger your capital account, the larger your position size can be, still abiding by proper risk management. So what does that mean? Well, why? So why doesn't a 1R mean that you only have to get half your trades right? Because you don't get, the way it isn't every other one, right? It isn't you're going to win this trade, you lose the next one, you win the next one, you lose the next one, you win. That isn't how it works. The reality of a trader is that you're going to get into these points where you win multiple trades in a row. What does that mean? That means you compound faster, because each trade you win in a row means you're using a larger position size, which means you're making more profit for the same, whatever it is, 1R trade, 2R trade, whatever, right? Which means you then have a larger position size, and then you win the next one, you make more profit, right? So you're exponentially increasing your account over those times where you're winning consistently one after another. The opposite happens when you lose, and you will get into situations where you lose multiple trades in a row, 2, 3, 5, maybe even 10 trades in a row. It happens. It's part of trading. And so what does that mean? Well, if you're losing 10 trades in a row, that means, you lose one, you're down, right? You lose another one, you're down, right? But now, and even though your losses from a pure dollar figure amount are going to be less and less, right? Because your position sizes are lessening with each loss, right? You're still going to have to make up those losses before you can even go forward. So no, having a 1-to-1, RR, having a 1R does not mean you have to, that as long as you're making 50% of your trade, you're going to be, good to go. You're probably going to have to focus more on 55%, 60% even, to guarantee as much as possible that you're going to at least break even. That's why I always tell people, focus on, minimally it should be a 1.5R, but realistically, you shouldn't be taking trades that are less than a 2R. And when you're taking on an especially risky trade, you should have a greater return possibility. I see y'all out here all the time, and you go and you take a really risky trade for a minuscule, just an average return. Why are you doing that? If you are willing to risk, to put more money out there on a riskier trade, you absolutely should require that there is a greater return. Now, if you're just starting here and you're just learning about trading, this doesn't mean you grab this little tool and you go, I'm going to say the target's right here, and that's going to give me a 3.6R. So for every dollar I'm risking, I'm going to make $3.64 if we hit my target. That's not how you do it. Your targets have to be real targets, right? They have to be realistic targets. So when you're doing that, you need realistic targets, right? You need realistic, whatever you want to call it there, good entries, decent entries. Entries are nowhere near as important as your exits. Your exits are so much more important than your entries. But you also need to always use proper risk management. See, these are the points where most traders get caught up. They get caught up on using proper risk management. They don't want to do it. First of all, most don't know how. Second of all, it's boring. Third of all, it interrupts their ideas of, oh my God, they're going to be millionaires next week. Let's be honest, guys. When you come in and you're looking at a trade, you're thinking big targets. What am I going to do with all this money that I'm going to make when my target hits, right? And so you've already convinced yourself it's going to happen when there's no guarantee. And so doing proper risk management means, well, I have to lessen my position size, which means my target won't make as many overall dollars, which means I can't buy that Lambo with this trade. So, as traders, you tend not to do it. But that's exactly why you're losing over and over and over again. I saw somebody's post online here just right before the show, and they said stop losses are for losers. Now, I hope that was just to get people in there talking. But then they went on about how real traders don't use stop losses. And that's the dumbest thing I've ever heard. That is the absolute dumbest thing I've ever heard. Real traders do use stop losses because we understand that the only thing that you control is how much you lose. By extension, what do we mean? The only thing you control is your risk exposure. That's what we're talking about, right? Because at the end of the day, your dollar returns don't mean a damn thing. Your P&L doesn't mean a damn thing. Your risk-adjusted return is what matters. It is the only thing that matters as a trader. Let me say that again. Your risk-adjusted return, not your P&L, your risk-adjusted return is the only thing that matters as a trader. And the only thing you control with that then is your proper risk management, right? How much you lose. So you can't just willy-nilly throw it all into a trade and cross your fingers, YOLO, I hope to God it goes up because I'm going long, or it goes down because I'm going short and I make all this money. Because your risk is infinite at that point. You're risking everything. But you have no infinite return coming at you, especially if you're short, right? Because short, you can only short so far. Right? You can only go to zero. But that's where we kind of sit, right? And so as a trader, you often come in and that's your mindset. It's all about, well, I'm always thinking, putting everything I have into the trade. And then you're thinking about how much money that's going to turn into when you're correct. Not if, but when. And most traders never really get it. They never really learn how to trade. Never really learned about markets. So you're going all in with everything you got, thinking you're going to win while knowing you don't know a damn thing about markets or trading. How silly is that? Yet we all do it. We've all done it. I did that when I first started. That's why I kind of, chuckle a little bit here, because that's what I did when I first started. I still remember to today, right? Got me absolutely nowhere. It got me the same place it gets you. Losing all your money. It took me a while to break that habit, figure out, oh my God, what the hell am I doing here? I need to stop with the nonsense. But you can't have that conversation with yourself if you don't take responsibility for your trades. If you went long or short with a position because somebody online or some friend said to do it, guess what? That's your fault. But they said it was a guarantee. They said it was going to do it. They said there was no way it could not do it. I don't care what they said. You took the trade. It is 100% your fault if you lost money on that trade. Right? But we don't want to be that way. We don't want to. We don't want to, accept responsibility. We don't want to have that difficult conversation with ourselves. And guess what, folks? If you're just now, realizing this with trading, surprise, it's everywhere else in your life too. Your brain does not disassociate between trading and the rest of your life and every other aspect of your life. You do the same thing in trading that you do everywhere else in your life. So again, I like to remind you that if your life generally is, I'm a victim, right? It's always somebody else's fault. I have no control. If that's your thoughts, I'm going to tell you right now, by the way, it's as true as you believe it to be, which means that when you realize that it doesn't have to be that way, that you actually can have that control, you actually get the control, right? But as long as you're feeling that way, You can't be successful in trade. There's absolutely, it's impossible to be successful as a trader, because trading requires honesty. It requires you getting to know yourself, because trading is about constantly looking at what you're doing and adjusting based on what's going on, based on how you're evolving, based on what's going on in the markets, based on the economic environment, everything that's going on, right? And you can't adjust if you can't have an honest discussion with yourself about what you maybe did wrong in the last trade that caused you to lose it, because, oh my God, I don't want to, admit that I lost money on that trade. See what I'm saying? You've got to be there for yourself. You've got to be your own best friend, and best friends shouldn't be just sitting there telling, their friends what they want to hear. Should be telling them what they need to hear, the honest, the truth. Doesn't mean you have to be a jerk about it. I think some people, they completely make that leap, right? Oh, I have to tell them. Well, here, I'm going to tell them. And they just completely shred them, right? No, you don't have to be. But you also don't have to beat around the bush. Just be honest. And you, as the person receiving that, should be like, okay, yeah, I see that. Okay, now I can use that information to change my approach. It is so important to do that with trading. Okay? If you can't do that with trading, you can't possibly remain in, because you're going to continue to make all the same mistakes you're making that all the other traders that are losing money are making as well. You got to do something different. If you want different results, you've got to do something different, right? But you can't do something different until you admit that there's a reason, a need to do something different. And that reason or need is because what you did previously wasn't working, or wasn't working as well as it could have. This is why traders, I'm going to be honest, guys, it really comes down to, personally, what I believe, with my background, my experience in the markets, and then, my master's in psychology, all that kind of stuff I have, right? This is one of the overwhelming constants that keep traders from actually becoming successful as traders, is their inability to have an honest conversation with themselves. Right? I don't know why that just happened. I don't have any markets up there, any charts up there, mother one. But anyway, so if you get anything from what I'm talking about today, let it be what I just said there. Honestly, that is probably the biggest takeaway you can get from here, the best takeaway that you can get from what I'm saying so far. You have to be honest with yourself. You have to, look at what you're doing and go, okay, I need to change this. It's my fault that I lost money. When you lose money as a trader, that doesn't define you. It shouldn't define you. But we, as human beings, tend to make it define us, right? We tend to have it define us. No bueno. That doesn't work. You can't be defined by your losses, and you can't be defined by your winners either. Don't be defined by your trading. Trading's a thing you do, right? That's another thing. Maybe you can think of it this way. I used to always say, I'm not anything special, right? I'm just a guy who does a thing. That's what it is. Oh, but Chris, you got all this education. Yeah, that doesn't matter with my trading. That doesn't affect my trading, positively or negatively, right? Which means you don't have to have a big, high education either. But what you have to have are honest conversations with yourself. You have to disassociate yourself from your trading. You are not your trading. You are you. Trading is a thing you do. So if you lose money or you make money, that doesn't change who you are as a person. That doesn't change what makes you you. That doesn't. That's just a thing you do. That's the result of a thing you do. Right? It doesn't change you as who you are. It's a thing you do. It's the result of a thing you do. And I think the more you focus on that, the easier it is to have those honest conversations with yourself. The whole reason we don't want to be honest with ourselves whether in trading or the rest of our lives, any other area of our life, is because that might mean, oh, we're to blame for something. And we don't like to blame ourselves for anything, right? We hate blaming ourselves. It's painful to blame yourself. It's much better if we sit back and go, oh, it's so-and-so's fault. It's the government's fault. It's the market maker's fault. It's Wall Street's fault. It's crypto whale's fault. It's my girlfriend or my boyfriend, my husband, my wife's fault. It's the kid's fault. Right? It's easy to blame everybody else, but ourselves. But here's the thing. Even when those other things do have some interceding, right? Some interceding blame for what's going on, you still have some blame yourself. If you find yourself in a situation, there are choices you made that brought you there. Guess what? You're not at fault, completely faultless. Now, that doesn't mean you have to take their blame for the things that they did, but it means you have to take responsibility for the choices you made that led you to that position, that particular period in time, that thing that's going on, what you're dealing with. Okay? That's what we're thinking there. Bitcoin just hitting the half fib, the 50% fib. Yeah, right there about mid-range. So let's see if we can get a rejection around this area. You can see that the 4-hour RSI is almost overbought there. Right? So can we? Right now, we have hidden bullish divergence in progress. Right? And we'll see how it continues to play out here. Can we get a rejection around here? High volume node coming in there. Previous resistance area right here. It's a good place to get a low volume node below it. It's a good place to find some support here. So what does this mean? Well, right now that means our target, if we can get the rally, it's a bit higher here at this point from where we're at. Up there closer to almost 132,000 now. Now my 50% pullback on this rally right here is a bit lower still at 117, 115. It's still there, kind of just above this kind of resistance area here, resistance support. So my big picture is I'm looking for this reversal. Can we get this reversal and rally up? If we can't, if we continue going lower, I'm going to look here to this S1 pivot on the weekly here at 114,882 is my next target. Now with something like that, this becomes then a 1, 2, 3, 4, and 5 as a leading diagonal for a wave 1 of that larger 3. The only way materially here on this chart that things change is if we continue to drop down below this swing low here at 108,713. At that point, this becomes what appears to be 3 waves up, which is corrective. But even at that point, I think we would be likely to get a sweep of this low right here and back up. But this is what trading is, right? Trading isn't, it's definitely got to go here, catching knives and whatnot. It's like, listen, what are we looking at? What do we know about structure and movement that can let us know about where things are potentially headed? And if they then reverse from that area, where can we look for them to go? If they continue through it, where would we be looking next as far as targets go? So again, what do I teach? What I teach at our trading academy is I teach folks to look at their higher time frame targets, the higher time frame points of interest, levels of interest, areas where you would expect a rejection. But you don't just put a bid there. When you get to that area, then you zoom in on your smaller time frame and you start watching to see if a reversal is developing. Right? Which is opposite of the way most traders get in here, right? Most traders They look and they go, oh, I'm going to put my bid in here. Yeah, that looks like that may be the area there. Where's your stop loss? Most people don't even have a stop loss. They say, oh, I'm just going to buy it. And then they become holders of forever, right? Because you never had a clear entry, stop loss, target kind of thing. You were just like, well, I think my gut says I think this is going to go up from here. So I'm just going to get in here. And then you're all upset that you end up holding the bag because it continues to die on you, right? Continues to go down on you further and further and further. Yeah, Mr. Awesome says, sometimes, though, I'm too hard on myself and my mistakes. Yeah, but again, that's because you're saying you are those mistakes. But you're not your mistakes. Your mistakes are things that happen. They're the results of things, of choices made, right? But they're not you. And as soon as you really understand that for yourself, you can separate them from who you are. They don't define you anymore. And that's where the true freedom in living is. When your mistakes and the things that you say and do, where, your mistakes along the way, they don't define you. That's what you should get. That's what you should strive for in life. Now, here's the thing. A lot of people out there that most people haven't never got to that point. And so a lot of people are going to try and force you to be your mistakes. Don't have time for those people. Just turn around and walk off. You don't even have to explain to them. Stop trying to explain to everybody and appease everybody. Understand what I'm telling you. You are not your mistakes. You are not your decisions. They are a product of what you do, but they aren't you. You're never going to make 100% correct decisions in your life. You just won't. So if you know that's the truth, if you know that's the reality, then stop defining yourself by the decisions you make. If you make a decision, it doesn't work out the way you're hoping it would work out, look back and go, okay, what did I do that didn't get me where I wanted to go? And how do I change that? How do I make it better? You're going to be so much better off, not just, with trading or whatever, but just in life. There's gold. This is not a bearish engulfing candle. Why not? Because on the day, if you look closely, you can see that it gapped down. Bearish engulfing has to engulf the candle. It's not engulfing that body of the candle. But it is a strong move down on a big spike of volume at so far the top of this rally. When you see this, it's not just a volume with a big candle. You see how it continued up? But it's a big volume spike here with this big reversal candle. And what I mean by reversal candle, I just mean going in the opposite direction, right? So when you see that, you should assume your position should be that you're going to pull back further. Now, it doesn't have to happen. It might not happen. But when you see that you've got a trend and you're at the top of your trend with a big spike of volume and it turned around and you've got a bigger candle to the downside than you had the upside, this becomes resistance. Doesn't mean you can't break up through it, but you should be leaning to the likelihood of it going down further. So that doesn't mean you take a short immediately right here. You wait for some confirmation. Maybe you zoom on a smaller time frame, look for a breakdown, a retest, and a breakdown, whatever you're going to do, right? This is now controlling. Now, if you can get a daily close above where it opened here, suggest further upside. And I'd look up here at the R2 pivot at 41.5270 as kind of my next general target. But here, if we're going to get further downside, you could potentially get bounces here, around 38.60 or, but I think overall, if we're losing it here, we're probably coming down to this area right here, 37.59.5 up to 3,800. So rejection here, come on down here, and then looking for a reversal here that's going to carry us on the next move up. Which, if we got that pullback, you might be looking up here, pattern target up there around 42.86 next on that move. If this low holds here and we're breaking out higher, again, just a simple price action target, just measure out the height of that from the swing high to the swing low of that correction, and gives you a 4177.7 target, just above that R2 pivot there. Okay. There goes your daily gold longs. Well, then you can get into daily gold shorts for a bit. Galton, what's up? Says, anybody that's not TWC, do yourself a favor, get in, even if you're a degenerate, but especially if you're a serious trader. I love that, man. I appreciate that. Thank you. Yeah. Again, we teach, I offer a lot of teaching, guys. And at the end of the day, what my teaching really goes around and what it's directed to is for you to understand liquidity in markets. How does liquidity develop and why? How can we understand where it may be headed? How can we understand ranges? What's going on in the range? What should we be looking for? How do we, forecast where price may be headed and why? Where do we find those areas of support and resistance, those areas of liquidity along the way as well? And you can apply that from the 15-second time frame to the yearly time frame. All that works there. But we give you hundreds of hours of educational content in our vault, right? We do 3 times training each week. We do it on Mondays, Wednesdays, and Thursdays. And that training is there to help you take the education from theory into actual application. Because I'm going to tell you whatever you're learning, guys, it rarely looks the same in practice. And you have to get used to that. Why are we doing this? And then I also am able to kind of help you understand, well, even though it's looking like this, experience tells me this other thing may be what's going on. And I explain why, right? Again, trying to help get you beyond that curve a lot quicker, right? But we also do live trading on Mondays, Tuesdays, and Monday, Tuesday, and Thursday mornings. And we trade like the 15-minute to the 15-second to the 5-minute time frames. And we show you how that shorter time frame, how it affects you when you're trying to figure out really quickly what's going on. And how do you approach that, right? Anybody can learn how markets move, how liquidity flows, all those things. But how do you approach that market on that day at that time? How do you approach trading? Those are the things that really make a lot more difference. Because most people aren't taught that. They're just taught, hey, listen, if it does this, it might do this and then do that. But you don't have any real understanding of what you're doing, which means you can't evaluate the potential setup. And if you can't evaluate the potential setup, you don't know if you should even take the trade. You just assume you should take it, but why? You don't have to take a trade just because there's a chance. You should be taking trades that are much, much, much more likely to play out than not. But most of what retail does is try to take every trade, right? I actually posted, for those of you that follow me on X there, I posted a thread here because I posted a, let me see here. I posted a tweet and I said, what did I say here? You don't need more setups. You need fewer exceptions. And then right as I was thinking about, maybe some people aren't going to understand that, I had somebody ask me, well, I don't understand what you mean by more exceptions. And I was already starting a thread, which I then posted, entitled, Everyone Wants a New Setup, but Nobody Wants to Admit They're Breaking the Old One. And we go in there and to explain. And basically, this is, again, another way of, well, how do you approach trading, right? Because traders tend to want to get into every single opportunity out there. And if there isn't one at the second, they try to force one. And really what that usually results in is in you losing money. But most people don't focus there. They're so, hyper-focused on that they can't see the forest for the trees. And they don't realize that they're setting themselves up to lose a lot more money over and over and over and over and over again, rather than fixing that leak, right? Fixing that leak. Stop finding those opportunities to just jump in because there's a chance, and instead start looking for legitimate opportunities. A lot of that happens even when you learn to trade and you get a setup and setups that you like, right? But then you don't see anything happening with that setup. It's not showing up. So you start bending your rules. right? Your rules should be strict. Either the rule, hits or it doesn't. And if all your rules don't hit for your setup, then you don't enter. It's really as simple as that, right? But for a lot of people, they don't do that. They do the opposite, right? They get in there and they'll say things like, well, it almost fits, right? This is why with patterns, those of you that follow me, especially if you've gotten any training from me, you know that I'm very, very much a stickler for patterns, right? I want to see impulsive movement between support and resistance, strong movement. And I don't go out here and draw these lines through it and say, oh, well, it picked up and came back in, whatever. No, if my line is there and it breaks out and falls back in, then my line was not important enough. So that pattern to me is not relevant. I'm a stickler for that. Some people be like, oh, it's okay. It popped out a little bit and came back, and then we'll fudge it a little bit, let it be. No, this is exactly what I'm talking about. It almost fits. No, we're not interested in almost fitting. Because when you open yourself up to allowing things to almost fit, you really take yourself from strong adherence to your rules to just pretty much anything flows. And it gets more and more like that. You make more and more excuses. You're in a trade and you say, I'll move this stop just this once. Right? No, your stop, if you did it correctly, your stop is there because it informs you that what you thought was going to happen is not going to happen. And the goal is to be out as soon as possible so that you're not picking up more and more losses. I screwed up with, I've passed since August, May, or April or May with our students in front of them. I think I've passed something like 9 prop accounts. And I think I've blown 3. I just blew one yesterday. For that reason, I didn't have a stop set. And then I was in the moment, things were down, and I kept thinking, oh, it's going to reverse. I've been doing this 31 years, guys, and it still got me. It happens. That's the reality of trading. Thankfully, it's a good training point, right? Let them know, listen, this is what's going on. Can't be doing that, right? That's why we want to have rules and want to stick to our rules, and we don't want to fudge them. We don't want to say, oh, this time I'm not going to do this, or this time I'm going to move this. You get into a trade and you go, man, you know what? It looks good on the 5-minute time frame. So I'm just going to ignore my rules that I have to hit because it looks good on a 5, gut feeling, it looks good on a 5-minute. That whole, as a matter of fact, yesterday, that whole trade yesterday, that stemmed off of what I believed was going to be a triangle leading into the open of the market. It looked really good. And at first it went up, I'm like, okay, great. And then it started coming down. And then it just kept going down there. And, and I should have been out. I should have already had that. In my head, I had my stop loss, but I didn't put it on there. And once you don't put it on there and it starts pushing through that, it becomes much more emotional. We're human beings, guys. I keep telling you, you will never, as a trader, lose your emotion. It will always be there. What you can do is learn to put together a plan and then follow the plan and do that. But even with that, you're still going to make mistakes from time to time. A lot of what I do with our live trading, whatever there, is to let them know, listen, I'm not perfect, and you're never going to be perfect either. And you're going to make these mistakes, which is why it's important for me to remind you of them. Now, you're going to make a lot less of them the longer you're in. Again, I've passed like 9 prop firm challenges, blown 3. So I've got like, what, a 66% pass rate on those prop firms, which are notoriously different. They're designed against you. But that's the other thing we talk about in live trading. We talk about how you have to trade a bit differently with your prop firm in mind because you have end of day or whatever, limits that you can't go through, and your targets are limited, 50% of your overall target. You can't do more than that. Otherwise your target extends, blah, blah, blah. And so it's a different way to kind of approach prop trading as well. We've had numerous students pass multiple prop firms. Our man Sats McGee, it looks like he left here already. He passed his prop firm this morning. Congrats to him, of course. Mr. Awesome is passed a few himself as well. We've got others in there. Roy passed his in 3 days. Absolutely fantastic. 3 trades. Using a technique I taught in our price action Wednesday sessions. That's all he did. He used that, passed it in 3 days. 1 trade a day for 3 days. So, again, guys, we do a lot, and some people feel a little overwhelmed. Don't feel overwhelmed. Just start with the courses. Start attending the live trainings as you feel comfortable doing it, because that's where you get the real sauce. That's where you get that move from theory into application. Because otherwise you buy a book and you read it and nothing ever looks as clean as the maps, the charts on the book, right? Because when we're trying to teach, we need to have something that shows clearly what we're trying to teach. The thing is, most of the time, those structures and whatever are going to look a heck of a lot different in the live charts most of the time. So you have to be pushed into. You have to figure out, okay, well, how does this apply in this thing that doesn't really look exactly like that chart? And that's what we do. And the other thing that I do with the live trainings there 3 times a week is, like I said, on Mondays we focus on Wyckoff, the Wyckoff method. On Wednesdays we focus on price action and volume. Thursdays we focus on Elliott wave. But in each one, I'm always referencing the other things that you're learning so that you can see how they all play together, how they all come together, how they all strengthen your probability of what you think is going to happen. And so they're really great. And you get access to hundreds and hundreds and hundreds of hours of that, because I've been doing that for years. You get access to everything that I've taught. But you don't have to attend absolutely everything. Start with the courses. Go through that. Ask questions. Come to a few of the live trainings. Or if you can't come to directly, watch the recording and ask questions. I want you to ask questions. You need to ask questions. As somebody who has 2 master's degree and a law degree, I'm going to tell you, the best way for you to learn is to ask questions. Too many times we're scared to ask questions. But you need to ask questions. And I'm going to tell you right now, if you're trying to learn something from somebody and they sound irritated that you've asked a question, or they tell you not to ask questions, or they don't give you the opportunity to ask questions, run. Don't walk, run. Because they're not there really to teach you. They're there to regurgitate something and sell it to you. You need to be able to ask questions. Active learning is where it's at. And I make it possible that you can ask it during the lives and that you can ask it during afterward. When you watch, anytime you happen to watch the videos afterward, recordings, right? Because how else are you going to learn, guys? You might be able to learn without asking questions, but I guarantee it's going to take you a heck of a lot longer. Right? Plus, you get access to charts and trade setups that I don't usually post anywhere else. We do them in those training sessions based on what we're learning, what we're talking about that day. So a lot to go on there, a whole bunch of stuff. Of course, you get access to Fibbo and his, he's got a course on there to teach you how to do what he does, his particular trading that he does. And you get updates to his charts every day and his positions and what he's doing. And you get access to Andrews and Vince's trades, and you get the market wrap and multiple Bitcoin updates throughout the day. So a lot going on there. But anyway, we'd love to have you there. You can join. You can just hit that little, what you call it there, that little, what's it called? QR code, top of the screen there. That'll take you there so you can see it and check out what you get and all that. Feel free to ask questions if you have them. But man, oh man. I think that'll do it for today. I ended up talking a lot more about trading and things that you need to understand and how to go about it than I planned on it, right? Do you know if Fibbo is still expecting a $209,000 fib level to hit in Q4? I don't know that he's ever said it definitely has to go there. I think what he said was this is setting up as if it does this, this, and this, there's a good chance it's going to hit that. I think that's probably the way he meant it, if it didn't come out clearly like that. But I don't think he's changed anything on his ideas yet, as far as anything goes. We're just into October here. We still have over 2.5 months still to go before the end of the year. So a lot of time, especially if there's a blow-off type top, something like that to happen. I do think that he was, I think one of the recent times we were talking, maybe in one of the live streams he was on here, He mentioned that it's possible that that his upper targets could get extended into Q1 of next year. So yeah, I don't think he's not necessarily expecting to get there. I think he still thinks that's a good possible target, but it may extend into Q1 rather than Q4. So I think that answers your question. Anyway, there we go, guys. As always, remember the only thing you control is how much you lose. So please keep working on that risk management. I hope you got a lot out of this this session here. We only kind of looked at a few charts, but really I wanted to kind of focus on understanding what it means by this time is different and what it doesn't mean, and how this time is mechanically different, but functionally, you know, people are still people. As well as I got into there at the end, I didn't plan to do it, but really kind of went into about trading, right? And about how can you become successful as a trader? Because here's what happens. If all you want are signals of when to buy and sell, you're never going to make a lot of money as a trader, because you don't understand the rest of it that's involved. It's impossible to be a successful trader without understanding that, right? But if you are serious about really wanting to learn this skill set, then that stuff I was talking about here at the end, midway through the end there, is absolute importance, because that's going to decide how you approach the rest of trading. And you have to have that foundation, that psychological, emotional, mental foundation that sets the stage for you to be able to become a successful trader. Otherwise, you might be you might even become a successful trader for a bit, and just one event wipe you out completely, and you'll never make it back. Because, you know, again, you'll continue to associate who you are with, you know, whether you won or lost a trade kind of thing. All right. So you have a great weekend. Trade safe, y'all. We'd love to see you in there. If you do join, man, I send you all a message out when you join. You know, reply back, say hi. I'm not going to bite. I'm here to help you make sure that you become the best trader you can possibly be. I can't do it for you, but as long as you're putting in that effort, discipline, consistency, focus, you know, proper practice, if you're doing those things and asking questions, it's all but impossible for you to not become a better trader, to not become a more successful trader, a consistently profitable trader, right? And if that's not your desire, then you shouldn't be in the market anyway. You're just giving your market to me and everybody else. So words to think on, food for thought there, I guess you could say. But again, yeah. Hey, by the way, also, I mentioned it earlier, go to themarketbreakdown.com and sign up for that free newsletter. And starting today, every Friday, we're going to have Fibonacci Friday. It's a corner of the newsletter where Fibbo is going to actually write. I see what he's already got for this week. It's great stuff. I think you guys are going to really love it. And so, man, that's the only place you're going to be able to get that, by the way. He's not going to post that anywhere else. So jump on it, all right? Thanks a lot for joining in, as always. Y'all have a great weekend, and I will see you later. Take care, everybody.
Trading tip: always manage risk before chasing gains.